With all the craziness in GameStop and AMC movie theaters and a host of other stocks, I thought it'd be important just to jump in and make a quick video to talk about it. Believe it or not, what's happening with a hedge fund shorting a position and getting caught up and moving a security up and or down is really not that uncommon. So what's making this story such a big story? And before I get to that, I really got to talk a little bit about what the idea of shorting a stock is. In essence, when you're positioning your portfolio to be short a position, you believe that position is going to go down for whatever reason. You believe that position is going to move in a negative direction. So you could actually position the portfolio in such a way that you could benefit from that move. The mechanics behind it are pretty complex, but the down low is basically you're borrowing shares from a brokerage firm, the shares that you believe are going to go down in value. You immediately sell those shares. And when the price does go down, you get to buy those shares back at a lower price. You return the shares to the brokerage firm and you pocket the difference. So using simple numbers, if you shorted a stock at 100 and it went to 70, you were right. You get to buy back the shares at 70, return them to the brokerage firm and pocket a $30 return, positive return. However, when the stock or if the stock moves in the opposite direction, in other words, if the stock moves up, you now are losing money and you're faced with the possibility of having to buy back those shares at a higher price, thereby taking a loss on that short position. All right, so that's the concept of being short. And by the way, generally these are ideas or concepts or approaches used by more sophisticated investors. Hedge funds, there are a significant number of hedge funds that use these very routinely. So it's not uncommon for a hedge fund to be short stocks or the indexes or a variety of things. Okay? The second concept is a separate concept, but I'll tie them both together. And this has to do with the number of shares outstanding of a particular company. Every company that's publicly traded has a certain number of shares that are outstanding. Generally speaking, the larger the company, the household name companies that you know of, have lots and lots of shares outstanding. Therefore, they have what's called a very large float. On the other hand, you get smaller companies or mid-sized companies, they generally don't have a very large float. And as a result of not having a lot of shares outstanding, news or an event or buying or selling could move that stock a lot more easily simply because there are not that many shares outstanding. So for example, think about what it would take to move a company the size of General Motors or to move the price of Amazon or Apple or Facebook. It takes a lot more in terms of movement because there's so many shares outstanding versus a small company, right? So that's the concept of float. Now let's marry those two concepts together. So if you get a lot of people that are short a particular stock, and if that stock happens to have a low float, a move higher in that stock based on positive news or something good happening or buyers start to buy it, it creates what's called a short squeeze. And what that very simply means is that all the people that are short that stock, as the stock starts to rise, experience a pretty significant amount of pain. In other words, they're losing money. And what happens is, as those positions, as those hedge funds or those investors that are short have to step in to buy the stock back in order to close out their short position, in essence, what they start doing is driving the price even further. So in other words, it starts to feed upon itself in a negative move for the people that are short. So a short squeeze is something that is not that uncommon. It happens, and it is it oftentimes can cause a stock to move very significantly. All right, so what does all this have to do with what happened here recently? Well, you probably heard that in this group, in these chat rooms of Reddit, there was all sorts of chatter about let's go out and buy the stock. GameStop happened to be a stock that they targeted and said, here's a stock that we want to pile into. And in essence, what they started doing was buying the stock. And by the way, they were writing call options and doing all sorts of other things with the stock. In other words, driving the price higher. Because of the fact that the stock was heavily shorted by these hedge funds, it created that pain that I just referenced to. In other words, it created that short squeeze. So as the stock was moving higher, and by the way, it moved from like $20 a share to over $400 a share at one point. In essence, what was happening is as the hedge funds were stepping back in to close out their positions, they were driving the price higher. This group of investors was driving the price higher. And supposedly, according to the news, they were all smaller investors that united through this online forum. And by the way, it wouldn't surprise me if we learn soon that there were probably even some hedge fund managers in there on the opposite side buying the stock too. That's what made the news. The move from a stock to go from 20 to 400 in a matter of days is incredibly significant. So what does this have to do with you, and how does this impact potentially your portfolio and your investments? Well, naturally, something like this would lead to some greater degree of volatility. There has already been at least one that came public, and I think there's probably more, because when there's one cockroach, there's more. There's probably more than one hedge fund that has experienced some difficulty as a result of being in that short squeeze we were just talking about. So I think in the coming days and weeks, we'll probably see an elevated level of volatility. We'll probably see some of that volatility not only in GameStop and AMC, but we may see that in some other stocks, some great household names, because some of these hedge funds are going to have to start to unwind, and what the fancy term is, de-risk their portfolios. And as they start to unwind and raise cash in these accounts, they'll probably wind up selling some of the better stocks along with some of the weaker stocks. So it wouldn't surprise me at all to see an elevated level of volatility, as well as some weakness in some really, really, really strong stocks. So I don't think it's anything necessarily to get too excited about yet. This isn't something that is necessarily a change in the economy. It's not like we're going to go into a recession because of this or anything of that magnitude. But certainly, anytime there's news of big companies like hedge funds losing money, there's going to be volatility. Oh, and by the way, the final thing we might even see is it wouldn't surprise me if the government steps in and starts to impose some short-term regulation changes, or maybe even some longer-term regulations in order to try to save some of these big hedge funds. So hopefully you found this helpful. Hopefully you can make sense of it as you hear about it now in the news. If you have questions, by all means, let me know. If you like this video, go ahead and share it, like it, and subscribe. Thank you very much.